year 2022-23. I request all the members to stand up for ICA motto and put their right hand on their heart.
येष सुप्तेषु जागृति येष सुप्तेषु जागृति कामं 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 कामोषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यकश्चन एतद्वैत 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 एतद्वैत.
Thank you. Respected past conveners, professional colleagues, and the participant, and today's esteemed speaker, CA Nishit Parikh. Today's topic is Dubai corporate tax recent development. And today we have speaker Shri Nishit Parikh from who is partner in Sudhir K. Parikh and Company LLP. And he is having vast experience in the international and the domestic advisory. Before we welcome our speaker, I request our past convener, CA Aditya Maheshwari, to give a brief introduction of CA Nishit.
Good evening, everyone. Thanks, Jitendra, for giving me an opportunity to introduce our today's speaker, who's going to talk about an important topic, Dubai corporate tax recent developments. So, CA Nishit Parikh is MCOM and a fellow member of the ICAI with over 13 years of experience in advising domestic and international corporates on the matters relating to international tax, FEMA, and structuring of inbound and outbound investment, and has an extensive experience in income tax litigation, advisory, compliance, international tax treaty, provisions, and FEMA. He is a partner in Sudhir K. Parikh and Company LLP. Nishit has authored numerous articles, including topics such as indirect transfer of shares, business connection, BIPs, service PE, etc., which have been published in major industry journals such as International Tax Journal, Taxation Journal, Taxman, and Tax Sutra. He is a regular speaker at various industry forums organized by the Chamber of Tax Consultants, ICAI, Indo-French Chamber of Commerce, and Indo-American Chamber of Commerce on various topics such as overseas direct investment, international taxation, and FEMA. He also conducted a foreign investment masterclass for Corp Connect. With this brief introduction, I would like to welcome today's speaker, Mr. Nishit Parikh, and request you to kindly take over the proceedings. Thank you.
Thank you. Thank you so much, Aditya and Jitendra ji. And thank you for this opportunity. I will just share my screen. Let me know once the screen is visible.
Yes, sir. Yes, sir.
Okay. Thank you. Good evening, friends and seniors who are present today. I would be covering UAE's recent amendment in terms of introduction of the corporate tax and the transfer pricing law. During the course of the session, we will try to cover that as Indian companies, Indian individuals, what are the regulations on the ODI side, which will help us to make investment in UAE. Then we look at how the UAE corporate tax came into picture or how it was born, because there were various steps which happened before this corporate tax came into picture. Then deep dive into the law as to what is the scope of taxation, what is the actual regime. And we all know that in UAE, there is a concept of free zones, like what we have here like SEZs, and the free zones are more liberal in terms of the benefits which they offer, and they are very popular till 2021, because as we are all aware, before 2021, UAE had a policy that if you want to set up in mainland a company, you need a local partner. And actually, to get into a partnership with a local partner, many foreign companies, including Indian companies, were not comfortable. And that's where these free zones were offering 100% ownership. There were certain industry specific free zones in UAE, which kind of help build the entire ecosystem. And there are more than 30-40 free zones now in UAE, which offer tax incentives like no tax for 50 years, 100 years, depending on whatever they are offering with the government of UAE. And how it is going to change for those free zone companies, how the computation mechanism has been provided under the UAE law, then what are the specific provisions or unique provisions like tax groups, group relief, and surprisingly, they also introduced a provision on general anti-abuse rules, which is like GAR in India. And it is very interesting because the entire concept or the messaging which was happening from the government was that this is going to be a simple law. We don't want to make it complicated. But as we go through the law, we may see that while it may not be so complicated, but it has certain nuances which will need to be taken care by the corporates while doing business in UAE. And then finally, we will look at how the transfer pricing regime is going to look at in UAE, and then what are the administration and time permitting few case studies which I have tried to put across, and we can discuss those as well. And in case anybody has any questions, probably either during the session or whatever the conveners think fit, we can take it at the end of the session, and I will try my best to answer the questions to the best of my knowledge. So first, if we look at for an Indian company or an Indian resident, if they want to set up a business in UAE, obviously we all are aware we need to look at Indian FEMA provisions first before actually going and looking at the law of UAE. So recently in August 2022, Indian FEMA or Indian outbound investment regulations also underwent change. So today, as the regulation stands, Indian companies and Indian LLPs are allowed to invest outside of India, including in UAE companies and UAE limited liability companies under ODI regulations, that is overseas direct investment regulations. So if you look at ODI regulations that are broadly now divided into two parts. One is portfolio investments and one is the ODI investment. When I say portfolio investment, it is more to do with listed company investment, and where you are investing more for your capital appreciation. You are not interested in terms of participating in the management of that business. It is not like your subsidiary or a JV, but it is like, say you bought 1% or 0.5% shares of Google, then it would be a, without having any control in Google, then that is a more of a portfolio investment. So now the regulations earlier, these regulations also had certain complication as to what is portfolio investment, because portfolio investment was not defined. Now it has been defined. It says that investment in listed company about 10% would be considered as ODI, and investment in unlisted company, even if it is 1-2%, still it would be considered as ODI and not portfolio investment. As an Indian company or an Indian LLP, you can invest up to 400% of your net worth. So if your net worth is 100, your investment outside India can be 400. And net worth is defined as paid up capital plus free reserves. In specific situation, NOC is required from prescribed authorities. So say, for example, if you are undergoing any investigations or there are any cases against your company on the investigation side, you need an NOC from the respective authorities before you can make an investment outside India. However, if that is, there are no cases going on, then it is an automatic route. You just have to file forms with the banker and register a company there. Again, there are three types of activity which is not allowed from an Indian FEMA regulation perspective. You cannot invest in a company which is engaged in real estate activity. Again, real estate has been defined. and you will have to see whether what activity you propose fits under real estate definition provided under ODI regulations or not. Second is obviously gambling. And third is any company which is dealing in financial products which are linked to INR. So as we all know, the currency is very sensitive for India. So that's why this restriction is there. Under the ODI regulations, at the start, when you are making an investment, you need to file overseas investment form. And then on annual basis, APR form and FLA forms also are required to be filed for those investment. Similarly, an Indian resident individual also can make an investment in a UAE company or LLC. Obviously, there the condition is that you need to be within the limit of $250,000, which is the LRS limit per person per year. Plus, for a resident individual, you cannot have a step-down subsidiary. So you cannot have a holding company structure. That is, you cannot have a company in UAE and that UAE company having, say, a subsidiary in Europe. You can directly have one company only, and that company has to be an operating entity. It cannot be an holding company. So if you want to set up in UAE as well as, say, in Sharjah, then probably in Dubai you will have direct one investment, and in UAE you will have, in Sharjah you will have one more separate investment directly from your individual name, subject to that $250,000 limit provided under the LRS regulation, read with ODI regulation. Again, like I mentioned, no step-down subsidiary allowed. Investment in financial services company, not allowed to individuals. Corporates can invest in a financial services company, but an individual is not allowed. Similar kind of compliance requirement of filing form of overseas investment, APR, is there also for the individuals. Now, if we come to portfolio investment, individual again can make up to $250,000, but this is only listed company. And again, no compliances except filing of LRS forms. So here, no question asked, you can put money anywhere. It has to be below 10% and you should not be holding any board seat or any management control in that company. Again, for companies also, they are allowed to make portfolio investment up to 50% of its net worth. Again, same condition of less than 10% in listed companies that would again apply. Now coming to UAE. So UAE, as we all know, typically was considered as a tax beneficial country where there was no corporate tax. Also, there were a lot of challenges in terms of tracking of substance, tracking of what the businesses are doing at a global tax authority level. So when OECD and G20 in 2016 started this entire BEPS project, a lot of recommendations were made as to what all can countries do to strengthen their tax system, strengthen their financial system. And UAE was part of the inclusive framework of BEPS project. And hence it had to implement all the suggestions or the suggestions which were relevant for it as a country. They had to implement. So as a part of the suggestion, as we all know that originally in 2018, VAT, that is VAT, was introduced in UAE. And then in 2019, as per BEPS Action Plan 5, that is harmful tax practices, UAE actually underwent an audit from European Union Code of Conduct, and they recommended that there are a lot of companies in UAE which do not have any substance but have substantial revenue. And in order to give comfort to the international community that no, we are taking measures and there are substance in our company, on 30th April 2019, they came with a regulation known as ESR regulation, Economic Substance Regulations. So there were a positive list provided that following kinds of business would be covered under ESR. And once you are covered under ESR, you need to see three criteria mainly. What is a core income generating activity of that UAE entity? Where the head and brain, that is where the board meetings or where the company is being directed or managed from, and whether adequate assets, employees and expenses are incurred in UAE. So say, for example, if I have a company in UAE which is doing management services for the entire European region of a group, and it is making a revenue of $10 million, then we need to see who is kind of where it is generating revenue from, that is European region, whether the control or the management of the company is also situated in UAE, whether the board of directors are meeting in UAE, whether while for making $10 million as a revenue, whether it has adequate assets and employees depending on the type of business. If it is a IP driven business, whether that IP is registered in UAE or not. So all those criteria has to be examined in order to prove that it is compliant with the ESR regulations. And what we have seen that a lot of companies are now starting to face inquiries on the ESR side. We also have few clients where they have received communication from the authorities on the compliance and related to ESR as well. Now coming to corporate tax. So as a part of pillar 2, we all know that minimum corporate tax of 15% is going to come for companies where group level consolidated turnover is more than 750 million euros. But UAE, in order to ensure that it is treated as a leading jurisdiction for business and investment, and it wants to create its impression as a leading business hub and a hub where people can set up their companies to do business globally, had to create or bring in some measures which give comfort to the international tax community that it is not a tax haven, but actually a legitimate jurisdiction where people can do business without fearing that there are any malpractices which are happening. And in line with that objective of making it a leading jurisdiction, on 31st January 2022, UAE announced introduction of corporate tax. On January 2022, they just issued FAQ saying that they are coming out with the corporate tax law, how the corporate tax law would look like, and few questions around the corporate tax law. And on 28th April 2022, they came out with a public consultation document. It was a draft public consultation document, and they had asked for public comments by August. So basis that, the law was formulated and released for the public on 9 December 2022. And again with the law, they issued another set of 74 or 75 FAQs again were issued by the UAE government. Now, effectively, the corporate tax law is applicable from any financial year beginning 1st of June 2023. So any financial year beginning after 1st of June 2023, the corporate tax would kick in. So to give you an example, if a company has a financial year of 1st of July 2023 to 30th June of 2024, then from 1st of July 2023, the corporate tax would become applicable to that company. What we have seen is that most of the company in UAE follow a financial or a calendar year as their financial year. So most likely for majority of the companies, the tax year will start from 1st of January 2024 to 31st December 2024. And the due date provided is 9th month for filing of tax return and paying the taxes. They have said that 9 months from the end of the financial year. So for a year ending on 31st of December 2024, by 30th September 2025, they have to ensure they have paid the due taxes, and also the tax return has to be filed on or before 30th of September 2025. Now, let's look at the scope of taxation. So they say that any jurisdictional person incorporated in UAE, including free zone company, would be covered under the scope of taxation. So all your companies, LLCs, LLPs, JVs, unincorporated JVs, all would be covered under the corporate tax regime in UAE. Also, the free zone companies are specifically covered from a scope perspective under the UAE corporate tax regime. Only exception, they have said that for individuals, a natural person would be covered only if it is carrying on certain specified business activity. So here they have changed the definition slightly. Earlier, they had said that any natural person, in the draft consultation paper, they had mentioned that any natural person which does any commercial activity and which requires a license would be covered. Now they have said that specified business activity, and they will come out with the what is a specified business activity. They will come out with that list. Unincorporated partnership, they say that unincorporated partnership also would be liable to tax, and it would be considered as a fiscally transparent entity. So for partnership, the taxation would be in the hands of the partners and not in the hands of the partnership. Again, all the expenditure incurred by the partners and everybody would be allowed as a deduction, but only interest on partners' capital is something which is not specifically allowed. Again, foreign fiscally transparent partnership are also covered as unincorporated partnership, and again the taxation would happen in the hands of the partner. Then very importantly, they also have a POEM regulation. They say that any non-resident having POEM in UAE would be considered under the scope of taxation for UAE corporate tax purposes. And again, POEM is not defined very clearly. They have just said that POEM would mean that where key strategic business decisions affecting the business are made. We'll have to see whether any further guidelines comes on the POEM regulation, but currently there is no limit. So like we all are aware that from India law perspective, India has a limit of 50 crores, that only if the turnover or the receipt of the foreign company exceeds 50 crore, then only the POEM regulations are applicable. In UAE, there is no limit which has been provided. So even a single dollar or a single AED worth of transaction, if you are having POEM would be applicable if your key strategic decisions are taken in UAE. So typically there is a very popular structure whereby Mauritius companies, in order to not pay any tax in Mauritius, set up their directors in UAE as a company, and they said that our company is effectively managed out of UAE, so it is not liable to tax in Mauritius, and we will pay tax in UAE. In UAE there was no tax actually earlier. So now those kind of structures would have to be relooked at by the Mauritian company, where they have said that POEM is in UAE for their Mauritian company. So there is a specific concept of family foundation in UAE. So in India, like we have trust, not exactly like trust, but here again, family foundation is a concept similar to trust, where the foundation is managed by certain professionals, and there are assets in the foundation of the family, which mainly can be used for the benefit of the family or the beneficiaries of the foundation, similar to our trust. This is more done from the Sharia law perspective, because there are certain complications in terms of inheritance of asset by the female member of that community, and hence these foundation structures are also very popular from an asset protection perspective, as well as from delinking the risk to the assets of a family. So again, in the draft law, there was not any mention of what will happen to family foundation. So here now they have said that family foundation can make application to be treated as unincorporated partnership. So that means that if they don't make an application, then the family foundation itself would be liable to tax. That's the interpretation which is coming out from the law currently. So family foundation would then have to make an application. And in order to make an application, there are certain conditions which needs to be satisfied by the family foundation. And so one of the condition is that foundation has to be established for the benefit of the identifiable natural person. So it has to be ultimately linked to a individual or a natural person, or for benefit of public or benefit of the natural person and public both. So like a charitable trust kind of a concept, or for benefit of individuals who are there, or both. Second condition, that principal activity is only to manage funds or make investment. Foundation should not carry out any business activity. So foundation may then have a company under it as an investment, and that company may be doing business, but the foundation itself should not be doing business. And this entire foundation should not be set up for claiming any undue corporate tax advantage. So these are the 4 conditions. If you satisfy that, you can make an application and you will be treated as an unincorporated partnership. So we may be thinking that what could be the advantage of treating it as an unincorporated partnership. So like I elaborated in the previous slide, that the moment it is an unincorporated partnership, the taxation goes in the hands of the individuals or the ultimate beneficiaries of the foundation. So if as a foundation, and I am the beneficiary of the foundation, and all the investment income like capital gains, interest, and other income comes to me directly, I would be eligible to claim an exemption, because for individual, taxation, like we discussed, is only for some specified activities. So if the foundation is earning capital gains, there could be a tax implication. But if foundation ticks the box and is treated as an unincorporated partnership, then the income will go to each of the individual, and individual will be able to claim benefit, because for individual, taxation is only on the business income and not on the other income. Second, scope of taxation also covers non-residents. Non-resident earning income through PE or a source of income in India. This is very, very interesting, because source of income definition in UAE is a very, very, very wide definition. I was just trying to compare it with our 911 section under the Income Tax Act, and I felt that probably UAE definition is slightly more wider, or if not wider, equivalent to 911. And we will kind of go through it in subsequent slides, and probably we can decide whether how broad it is or not. So first, on the permanent establishment, they have gone by the OECD Model Tax Convention, and mainly 3 types of PEs have been considered under the UAE tax law. One is a fixed place PE. So it's a typical fixed place PE, which says that any fixed place through which business of an enterprise is carried out would be considered as a fixed place PE. Plus, an inclusive definition has been provided to include any place of business like factory, office, rental premises, branch, etc., to be considered under the concept of permanent establishment. Like all the tax treaties, they have given exception or exemption for entity setup or activities which are done in UAE, which are preparatory and auxiliary activities. So again, preparatory and auxiliary activities are broadly activities which are more preliminary in nature and does not form part of the core profit generating activities of the business. And that is how exception has been provided. They have also mentioned that if an organization is doing preparatory auxiliary activity through multiple entities, so say I have 2 entities and both are doing preparatory auxiliary activities, and if I club both the entities, then it no longer remains a preparatory auxiliary activity, then this exception would not be available. Second is a construction PE. So if as a company, foreign company, you have a construction site or a project in UAE, or you have series of project in UAE, and overall the period of the project exceeds 6 months, then you would establish a construction PE in UAE. Then third is dependent agency PE, whereby if you have a dependent agent, again, I assume the similar international principles would apply to identify who is a dependent agent. A dependent agent would be someone who is legally binding in terms of the contract, plus is economically also dependent on you, as well as is legally bound by you only. So majority of its income is, say, given by you only, then he is economically dependent on you, and also legally he is obliged to follow your orders. Then also he is legally also binding and dependent on you. And so that is one condition. First, you have to identify whether he's a dependent agent or an independent agent. If he's an independent agent, like an agent doing work, agency work for 10, 20 entities, then he will be considered as an independent agent only. But if he's doing only for you or your group companies, then we will have to examine whether he's dependent or not. If he is dependent, then there are additionally 2 conditions which needs to be satisfied. One is he's habitually concluding contracts on behalf of the foreign company in UAE, or he's doing negotiation of contracts which are signed by the foreign company, but broadly he does all the negotiation and there are no material changes done by the NR. Then also it would be considered as a constituting a dependent agent PE in UAE. One interesting aspect which has come out in the law and which is kind of not clear as of now what it would be, they say that also we will have another nexus rules, and if you have a nexus with UAE, you will be liable to tax in UAE. So these nexus rules are not defined as of now. they have said that they will come out with what are nexus rules, and basis that in addition to PE, we'll also have to look at whether a foreign company has some nexus in UAE or not. Then they have given a specific exemption for individuals. They say that you will not constitute, you means a foreign company will not constitute a permanent establishment in UAE in following cases: where a natural person is present in UAE, but that is because of consequence of a temporary or an exceptional situation. So one is it's a temporary presence, or it is because of an exceptional situation like COVID or something. Then he will not be considered as a PE of the foreign company in UAE. Then we have also said that if a foreign company has appointed a person in UAE on its payroll, then also that person will not be considered as constituting a permanent establishment in UAE if the activity conducted in UAE by that person does not form part of core income generating activities of the non-resident or its related parties, and that non-resident does not derive any state source income. So it should not have customers also in UAE, and also the activities done by that individual should not be forming part of the core income generating activity of that person. Again, from a PE perspective, what will get taxed is not coming out. So like we know that in the tax treaties, they say that income attributable to a permanent establishment would only get taxed. So currently there is no mention of attribution rules. I'm sure it would come. It should not be that if I have a PE, my entire income gets taxed for that transaction in that country. You will all have to look at attribution at some point in time, that what is attributable to the activities of the PE. And I'm sure that will come along shortly. Then there is no service PE clause. So like the treaties which we have with Germany and European, there is no service PE clause under the local laws as well. Now coming to UAE sourced income, it's a very, very wide definition and highly debatable as to how this would be treated and what are the consequences of this definition. They say that UAE sourced income would mean any income derived from resident person. So like India, if the payer of the income is a UAE resident, then it is sourced in UAE. If the income is attributable to the PE, then also it is UAE sourced income. Then income derived from activities performed, capital invested, asset located, right use, services performed or benefited in UAE. So even if you are doing some activity in UAE and there is nothing, there is no UAE party involved in the transaction, but some activities are performed in UAE, then it is UAE source. If it is from a capital investment in UAE, then also it is UAE source. Assets, then also UAE source. They have given an illustrative list of what would be considered as a UAE sourced income. They say that sale of goods in UAE is UAE sourced income. Income from service rendered, utilized, benefited in from UAE. So if you are rendering services in UAE, but you don't have a customer in UAE, still it would be considered as UAE. If some benefit is derived out of UAE, then also it would be considered as UAE source. So say for example, a foreign company has a contract with another foreign company for conducting an event in UAE for one day, then that UAE income would be considered as UAE source because the services are utilized in UAE or there is a benefit derived from UAE. Income from any activity in UAE, movable, immovable property in UAE. So it is very, very wide. So even income from IP insurance loans is covered. So even it says that the definition goes to the extent that if there is a transaction between two non-resident, and in that transaction, if some shares of a UAE company by a US company are kept on mortgage or are kept on mortgage and some income is earned out of it, that also would be considered as UAE sourced income. So why this is very important? So a foreign company where treaty protection is not available, what will happen is that UAE sourced income ideally would become under the scope of taxation of UAE. So technically it would be liable to tax. Now what would be liable to tax, whether entire income or only income attributable, or there would be certain exemptions for transaction like sale of goods and all of that. They have mentioned that they will specify certain conditions and limitation. So we'll have to wait for that. those conditions and limitations would come. This would also mean that non-resident to non-resident transactions and activities would also get taxed because the definition is very wide, even talks about benefit, partial activity being rendered under UAE, all of that is covered. So it becomes very critical for countries like US, Australia, Kuwait, Qatar, and Iran, because when I was checking, all these countries as of today do not have tax treaties with UAE. So if there is no tax treaty benefit available, straight away whatever income you are earning from UAE becomes UAE sourced income, and there could be a tax outflow in that country, and also probably at some stage compliance requirement in UAE because your income is liable to tax in UAE. Moving on, they have specifically provided certain certain entities which are exempt from tax, which are exempt from the scope of taxation, and obviously government and government control entities are outside the purview of taxation. Person engaged in extractive business and non-extractive natural resource business. So like we all know that mining of oil and other related activities could be critical activities for the jurisdiction itself, and hence they have excluded businesses which are engaged in specified extractive business and natural resource businesses. Obviously, they are two conditions. There are certain conditions which needs to be satisfied in order to claim this exemption, and also they are liable to subject. One of the condition is also that they should be liable to tax under the emirate level legislation. So there is a emirate level legislation which is there under UAE, and if they are paying tax there and they are also satisfying other conditions, then only they would be liable to this exemption. So say for example, if some entities are paying tax under emirate level, but they are not able to satisfy one of the condition which is provided under the law, then it will result in double taxation, because they will pay emirate level tax and also the corporate tax. And in the FAQs, it has been clarified that there would be no credit of emirate level tax which would be available. Emirate level tax, no credit of emirate level tax would be available while paying the corporate tax. Then qualifying public benefit entities and qualifying investment funds satisfying certain conditions. So again, they have given exemption to the entities which are doing certain specific work like investment manager and all of that, subject to satisfaction of certain condition. Public pension and social security funds are also out. Regulated private pension or social security fund, or any business which is controlled by the government entities or exempt persons, also would be exempt from UAE corporate tax. So now coming to taxation regime. So like we all know that they have given a slab rate of, not a slab rate, but an exemption limit of AED 375,000 AED. While in the final law, the amount is not mentioned. They have said that amount would be confirmed by the cabinet, but the FAQ issued along with the law and also earlier whatever documents have been issued, 375,000 AED is the amount which they have provided. And income above 375,000 AED would be liable to tax at 9%. So it is an exemption and not a slab. So first 375,000 AED income would be exempt in any case. Only, so if you are say making income of 500 or a profit of 500,000 AED, then 375,000 would be exempt, and only on 125,000 AED balance you will be paying 9% tax. They have on the withholding tax, or TDS as we call it in India, they have said that there is a withholding tax regime, but the withholding tax is 0%. So currently no obligation to deduct tax or file withholding tax return, but a withholding tax rate of 0% has been prescribed under the law. So this is very important because the rate has been prescribed. So tomorrow it is easier for them to make this 0 as 1 or 5 or 10 as soon as they test the waters and see how the reporting is happening from the businesses. And if they feel that reporting is not proper and tracking of non-residents without this withholding is becoming difficult, they may evolve the legislation and the withholding tax rate would be provided, and also compliance would coming on the withholding tax side. In addition to this, when the draft regulation was introduced, there was nothing like small business relief. It came out in the final RAW, which said that we will come out with a relief for small businesses. They say that small businesses can avail 0% corporate tax in addition to the basic exemption limit. They say that we will prescribe a revenue threshold for what companies would be considered as a small business, and they can make an election. So they will have to go to the federal tax authorities and make an election to be treated as a small business. And FTA can ask for details and other required information to examine whether they are actually a small business or not, to examine on a time-to-time basis. So again, lot of things in the law currently is open as to they will notify through the legislation. They have kept the buffer in the legislation to issue notification. So this small business relief, what is the turnover limits and other things would also come under the notification, and they will notify it shortly. Now coming to free zones. So like I mentioned, free zones were a very, very critical part of the entire ecosystem. So they cannot kind of do away with the free zone by introducing tax, because the free zone authorities have already promised no corporate tax for X number of years to various corporates who have set up. This is that commitment. So what happened was that the public consultation document, which came in April 2022, was slightly harsh in terms of, it said that if free zone entity does any business with mainland Dubai, then the entire income, even the income which was not liable to tax, like the income from export or income from free zone, all of that income would become liable to tax. And there was a lot of worry in this free zone companies, and a lot of representations were made to explain to them that this will not work because it's a very harsh thing. And basis that, in the final law, they have made some changes. They have said that for free zone companies, we will divide the income into two parts. One is qualifying income and one is not qualifying income. Again, what is going to be a qualifying income? They will come out with a notification as to what is a qualifying income. But if I take some idea from the draft notification, most likely the qualifying income would be export business, which free zone entity is doing. Second, business between free zone to free zone. So from one free zone to another free zone, if I'm doing business and earning revenue, that should be a qualifying income. Then all the passive income which I'm earning from mainland. Say, for example, I'm earning dividend from a subsidiary in mainland, or I'm earning any capital gains or other royalty interest kind of an income, which is a passive income. Then all those incomes should ideally form part of qualifying income. Obviously, this is based on what was there in the public consultation document, and they will actually prescribe what is qualifying income. In addition to earning qualifying income, they have to ensure that they maintain adequate substance in UAE. So like I mentioned that in earlier part of my presentation, that there is something called as ESR, Economic Substance Regulation, in UAE already. The law, corporate tax law, does not specify that whether, if I'm compliant as a free zone company with the ESR regulation, can I say that I have adequate substance, or I need to do something else to say I'm maintaining adequate substance in a free zone. Again, what is substance is subjective, as it is not defined. So it would be interesting to see whether they clarify that ESR would be good enough to say that you have a substance, or they will kind of subsume the ESR regulation into the corporate tax regulation, and that's how the compliance would happen. But ESR, like I said, that is applicable to everybody, even to non-free zone entities as well. So it would be interesting to see how this is done by the UAE authorities. But as of now, they say that free zone company needs to maintain adequate substance in order to claim 0% corporate tax rate. Second, it should derive qualifying income, like we discussed. And third, qualifying free zone companies or any free zone company has been given an option as to whether they want to go and claim this 0% tax rate, or they want to forego 0% tax rate. So we will see what is the benefit of that. I have covered it in one of the case studies. So free zone companies have options that either you take the benefit or you don't take the benefit, give up and you become a normal company and pay tax normally like everybody is doing. Then the free zone company also has to comply with transfer pricing regulation. So all the transaction which a free zone company is undertaking with the related parties or the connected persons has to be at arm's length. Then only they can claim the exemption of being a qualifying of being a 0% tax rate. Taxation of free zone is important. The language, the way they have worded, it appears that qualifying income would be taxed at 0% tax rate, and all other income which is not qualifying income would be liable to tax at 9%. So what I read is that for the non-qualifying income, the benefit of 375,000 AED exemption would not be available. And I feel it is rightly so, because you already have a exemption for the qualifying income. So all other income would directly get taxed at 9%. So you will not get that benefit of 375,000 AED, which is available to other companies. Irrespective of the exemption, even if say 100% of your income is exempt, free zone companies would be liable to obtain tax identification number and file tax return along with transfer pricing documentation. So the compliance is compulsory for free zone companies. So while reading all of this, couple of questions which came to my mind, and one was very relevant, was that for free zone companies which is earning qualified income as well as not qualifying income, the taxation is on profits, right? So in order to derive profits, I will have to have income minus expenditure. So technically, I will have to bifurcate my expenditure also. So from my accounting standpoint and my system standpoint also, I will have to bifurcate what are the expenditure incurred for earning qualified income, what are the expenditure for earning not qualified income. Then there would be common cost. Common cost, I will have to then look at general cost allocation principles, allocation keys to divide that, and whether in future that cost allocation keys would be challenged by the tax authorities would be interesting to see. But that is something not coming out of the law, but it's a logical interpretation which comes out that you will have to maintain separate cost or expense for your both the service line. Now, if we look at larger MNC groups, what will happen to them? Because even if they are in free zone and once the Pillar 2 regulation comes in, they will have to pay minimum 15% tax in each jurisdiction. So like we all know, Pillar 2 talks about taxation of a group in each jurisdiction. So if you have 5 subsidiaries in UAE, whether those 5 subsidiaries in average are paying 15% tax or not. If not, then you will have to pay 15% tax, and there are ways provided under Pillar 2 how the tax would be collected. So in order to counter that, the UAE authorities have mentioned that for free zone companies which are going to get covered under Pillar 2, they will come out with a separate regime. And most likely than not, they will also come out with a 15% tax rate for companies which are falling under Pillar 2, so that there is no tax loss to the government of UAE, because if they don't collect from those companies, the parent company jurisdiction would have right under Pillar 2 to collect those taxes. So I'm sure that they will come out with that 15% tax locally, and hence they will not lose out on the revenue. How the income would be determined? So what they have said that for tax purposes, we will consider the accounting profit or the book profit as the base for computing the taxable income. Financial statement for that have to be prepared in accordance with generally accepted accounting standards. So whatever, they have not specified a specific accounting standard, but they say that whatever is generally accepted in the industry, you can follow that. Broadly, IFRS is what currently most of the UAE company are using, and they can continue to use those for preparing their financial statement. Once that profit as per the financial statement is there, you have to do adjustment to various specified deductions and allowances which has been provided. So unrealized gains and loss. So if you have any unrealized gains and loss, you have to set it off or bring it back in the books and give impact to that. Again, here they have given two options. One is you do it everything, you reverse everything in the books, or you opt for a regime where you only give impact to the capital losses, capital unrealized gains on capital items only. You add back the losses and reduce the gains, or you do everything and make it neutral. So you have to elect one of the option. Remove all the exempt income if it is already part of the profits, like dividends, capital gains, foreign branch income, etc. Then give impact to all the reliefs and deduction as specified under the law, which we will discuss subsequently. Give transfer pricing adjustment. So under the transfer pricing law, which we will discuss later, they have also given cross adjustment also. So if there is an addition in my books, there is a corresponding adjustment can be made in the other person's book as well. That is what they have given in the law. Plus, if you have to make any transfer pricing adjustment suo moto, you want to disallow something, that also you can do it in the return. And then also exclude income and expenditure which are otherwise not allowable to the company, which are not related to business and stuff like that, that you will have to remove. Now let's look at certain key deductions which have been specified, either not being allowed or allowed in some proportion. And here, where a lot of companies can face challenges and may need to do something to structure it so that there is no tax impact to them. So for first is like what we have under Indian section 94B. They have also brought out interest capitalization rule, whereby they say that you look at your net interest income, that is your interest income minus your interest expense minus your interest income. So if there is a net interest expenditure in your books, that would be allowed only if it is up to 30% of the EBITDA. So if your EBITDA is say 100 and the interest which you are paying is 40, then only 30 would be allowed. Balance 10 would be carried forward for 10 years. So earlier this in the draft document, carry forward period was not there. So it was becoming a tax cost. But now they have under the final law brought this 10-year carry forward period. They are also saying that we will bring out a limit that it will not apply to certain cases where the interest is above or below threshold. This safe harbor limit has not been provided as of now. So like in India under 94B, it does not apply. The 30% condition is not to be examined if my net interest expenditure is 1 crore. So similarly, they will also come out with a number where this limit does not apply. Then there is specific exemption to banks, NBFCs, insurance companies from this interest capitalization regulations because their business is such. Then second and most critical from a UAE perspective is business promotion. They say that 50% of the expense on entertaining customers, suppliers, and business partners disallowed. Nothing doing, straight away disallowance. If you have any of this expenditure, it would be disallowed. Then they have given an illustrative list. So it's a inclusive definition. Plus they have said that what would be specifically not allowed. Meals, accommodation, transportation, admission fees, etc., machinery or anything provided, all of that would be specifically covered. So any meals, accommodation, transport, admission fees, everything is not allowed 50% straight away. Then other penal kind of expenditure, like if you are paying VAT and that is creditable, not allowed. If you are withdrawing anything from your business, like dividend expenditure, all of that would not be allowed. Any donation given, fine, penalty, all of that would not be allowed as a deduction. The third one is very, very important. Expenditure incurred for earning exempt income. So this is nothing but section 14A, which we all know under the Income Tax Act. And here also there is similar kind of provision. We all know what are the controversies we are handling on 14A. So here also there could be a big potential of litigation here. Again, how they have defined that, how do you identify this expenditure? They have said that you allocate the expenditure. First, you identify the specific expenditure. If what is specifically identifiable, you put it there. And then for expenditure which is not specifically identifiable, you allocate it based on reasonable method. What would be the method? They have not given. It is subjective. Businesses will have to decide what is attributable to earning exempt income, and they will have to allocate on their own. So obviously, we already have seen that how we are doing it in India. Probably those kind of guidance will have to be used and do this kind of allocation and ensure that unnecessary litigation is not there on this aspect. Losses which are not connected with business also would not be allowed. So this is interesting. What would be considered as losses not connected to business? So say I have an investment in subsidiary, and when I sell out my subsidiary and I incur a loss, while capital gains is not something which is there under the law. So whether it would be considered as a business loss or it would not be considered as a business loss. So some of these aspects are open, and it may kind of evolve in future as to how the taxation of these items may happen. Then related party interest. So if you are making interest payment, or you have taken any loan from related party and you are making interest payment, that interest payment, irrespective of this 30% criteria, would not be allowed if the loan is used for distributing of capital, distributing of dividend, redemption of shares, repurchase of capital. So if you are trying to take a loan from related party and give yourself money by dividend or distribution, capital, or etc., then that would not be allowed. So now on business promotion, few things we were discussing with our clients and few things came out was that what happens if I conduct a general event in UAE where I invite my customers, I invite my vendors, I even invite my prospective customers and vendors. And it's a very generic event, whether it would still be considered as a business promotion expenditure if I have a courtesy breakfast or a lunch in the event. Whether I can say that it is not really a business promotion, but a general event. So like some companies have celebrations, like 50-year celebration, and they call everybody. It is nothing to do with business promotion, but more of a celebration. Where those kind of expenditure would be covered because somebody would say that indirectly you are promoting your brand by doing these events, and hence it is business promotion, and hence it would be covered under that 50% disallowance. One more open point probably is that under under action plan 4 of BEPS, this interest capital deduction of 30% has been prescribed. But there, the action plan 4 specifically speaks about related party interest. And in India also the regulation talks about interest paid to related parties. But here the regulation does not specify anything. So it would even mean that unrelated interest payment is covered under this interest capitalization rule. Because wherever they wanted to specify the related party, they have specified. Here they have not specified the related party. So it appears that it will apply to everybody and not only to related party loans. Tax losses. So they say that loss, if you incur a loss in 1 year, you will be able to carry forward and set it off against your subsequent year's income. But they have come out with a caveat saying that only 75% of the taxable income of the subsequent year can be set off. But the loss can be carried forward for an indefinite period. So they want corporates to pay a minimum tax if their income is lower than the total carry forward loss. So let's look at two situations here. One is, say I am earning an income of, I have a carry forward loss of 200 and I am earning an income of 100 in next year. Then technically I should have been able to set up that 200 loss, 100 could have been set off and 100 could have been carried forward. They're saying, no, you cannot set off. You can set off only 75%. So out of 100, I can set off 75, and on 25 in that year, in spite of having losses, I will end up paying taxes. In reverse scenario, they are okay. Say instead of 100, my income in that year was 300. Then I will reduce 200 and pay tax on 100. Then it is okay. So every time I will have to look at my income, see what is 75% and whether my loss is how much, and then set it off. Further, tax loss which is incurred prior to the corporate tax regime obviously would not be allowed to be set off, incurred before a person becomes a taxpayer. So like I mentioned that there is an option to the free zone to become to come under the local laws rather than be under the 0% corporate tax rate. So if they opt to become to be covered under the normal provisions, but they have incurred loss after the start of the CT regime, but at that point in time they were under the exempt category, then the loss pertaining to that exempt category would not be allowed. Then any loss incurred from activities or asset generating exempt income, that also would not be allowed. But this also leads to an interesting point on the deductions. While we discussed the deduction in the earlier slide, one of the important point is that what happens to cases like bad debts. Say after the corporate tax regime is implemented, I have bad debts, but that bad debts are because of sales made prior to the CT regime. Whether that bad debts would be allowed as a deduction or not, there is no clarification on that. Similarly, if I have a write back, but the income which, the expenditure which was incurred for that write back was prior to the CT regime, then whether I have to actually offer that income. So on both sides, there is no clarification, and right now it is open. So a lot of planning can be done right now to ensure that there is no issue at a later stage in terms of this complexity. Then, like we have section 79 under the Income Tax Act, they also have something similar, but it is more liberal than our section 79. So they say that losses can be carried forward indefinitely if at least 50% shareholding is maintained. So similar to our 79 section condition, in the year of set off, you have to check whether 50% of the shareholders are same who were there at the time of incurring of the loss. If answer is yes, you will be able to set off the loss. Or they say that if the 50% shareholding condition is not maintained, but the future owners are continuing same or similar business, then also the loss would be allowed. So earlier there was a confusion as to what would be considered as a same or similar business under the draft regulation. So they clarified it in the final regulation, saying that same or similar business would mean if the same assets of the business are continued to be used. There is no significant change in the core identity. So if I was known as a software company, I continue to be known as a software company with the activities I am doing, the identity of the business is not changed, then it is okay. Then they give one more kind of relaxation, say that even if there are changes, but the changes is because of the exploitation of the same assets or services or products which were there before. So if I change my business, but to change the business, I am using the same assets and services or products, then also this would be allowed. Obviously, this condition like 79 would not be applicable to the listed companies in UAE. Sorry. Then in addition to carry forward of losses, there is a concept of transfer of tax loss within group. So one company can transfer its loss to another company for set off. So there is no tax outgo at a group level. So they say that if you have a 75% common ownership, then you can transfer loss between the entities. Again, the condition that only 75% of the taxable income can be set off continues here as well. And there are a couple of additional conditions saying that in order to transfer this loss, both the companies, that is the group company where you are transferring the loss and the company which is transferring the loss, should have the same financial year. And also they should be using the same accounting standards for preparing their financial statement, so that no undue advantage can be taken by any group. Again, free zone companies which are qualifying free zones cannot do a transfer. So if we look at an example, say company A is earning an income of 250,000 AED, for example, and company B, which is a group company with 75% common ownership, then the loss can be transferred. But as I mentioned, that set off would be eligible only to the 75% of the income of the setting of company. So 300 ka 75% is 225. So only 225 can be set off. and balance has to be offered to tax. So 300 minus 225, 75 will have to be carried forward, and this, sorry, would have to be offered to tax, and 25 would have to carry forward. So your only clarity which is required is that this 25 would be carried forward by company A or company B. That is not clarified because this is a set off limit to be 75%, but transfer can be full or it has to be only 75% is not clarified. My sense is that once I transfer, it has to be the entire transfer, and 25 should be kind of be allowed to be carried forward by company B. But here again, there is no clarification. So we'll have to wait for the clarification. Again, there is certain specified income where an exemption has been provided by the law. They say that dividends earned from a domestic company would be considered as exempt. So if I earn any income from domestic company, and that too I am a resident, then it is not liable to tax in UAE. Dividends or capital gains earned from foreign companies by resident. So if a UAE resident earns dividends and capital gains from its foreign subsidiaries or JVs, that would be exempt, but it would be subject to participation exemption. We will discuss the participation exemption in the next slide. Then any income earned by a non-resident from UAE from operating aircrafts and ships and associated equipment for international business or international transportation would be exempt. Only condition is that similar benefit would have to be provided to a UAE business in relevant foreign jurisdiction. So this also could be very, very interesting. So like in India, say Indian company doing shipping business in UAE, whether this exemption would be available or not would be interesting to see, because in India, as per local law, there is no exemption. We have this 44 BB or some section where there is a presumptive taxation for shipping and aircraft. But there is a tax. The exemption typically comes through the tax treaties. So my local law does not allow the exemption. So very technically, this exemption to the Indian company also should not be available in UAE. Then again, we will have to fall back to the treaty and see whether under the treaty the exemption is provided or not, and then claim exemption under the treaty, but it would not be available for the local laws if this is the situation. Then another exemption is for foreign branch profits. So here again, they have given two options. That one, say this is for UAE companies having branch in foreign countries. Say for example, a UAE company having a branch in India. They say that you have two options. One is you include all the income of your branch in your profits and claim a tax credit of the taxes paid in the foreign country. Or you claim a direct exemption. That is, you don't include income, you don't claim credit. So depending on the country and depending on what kind of taxes you are paying in the other jurisdiction, you will have to select these options. Also, you will have to do a selection one time and then you will not be able to change. So you'll have to look at it from a long-term basis and finalize this position for your company. So like I mentioned, there is a participation exemption for UAE company which are holding shares in other countries. So they say that the minimum ownership should be equal to or more than 5% of the share capital or the interest in the capital of that company. The country in which you are holding this investment should have a minimum headline corporate tax rate of 9% or more. So say for example, a UAE company owning shares in a Cayman Island company where there is no corporate tax, then this benefit would not be available, this exemption would not be available, and you will have to pay tax. Then the company where you are owning this 5% or more capital, either you should be holding this capital or shares for more than 12 months, or you should have intention to hold those shares for more than 12 months. And if you are not able to fulfill or you sell it earlier, that income will become taxable in the year on the day or on the month in which you sell it. And from a interest in a LLP or interest in capital, would means that you are also eligible to 5% distribution of profit. So it should not happen that you are a 10% owner in the capital of a LLP, but your profit share is 4%. Then this participation exemption would not be available. Not this last one is very interesting, and I'm still struggling that what would it mean? It says not more than 50% of the direct and indirect asset of the participation consists of ownership interest which otherwise would not have qualified for exemption if held directly by taxable person. So they are saying that somebody can structure it in a manner that they have a holding company where they are holding more than 5%, and they have multiple investment through that holding company where their multiple investments are not meeting the participation exemption test. Then also you will not get this benefit. So we will look at your ultimate investment. So more than 50% of your direct or indirect assets are not meeting the participation exemption, then you will not get that exemption even if you are receiving dividend from a 100% owned company. So this is very, very interesting. And one more interesting point is that while all these exemptions are available to resident company, there is no talk about exemption for a foreign company holding shares of UAE company. So say for example, an Indian company holding shares of a UAE company, if they dispose that shares, whether the capital gains is liable to tax in UAE, it would be considered as a UAE sourced income like we discussed. And if the treaty is not favorable, then technically it would be liable to tax. So here again, there is one confusion. The law does not provide for any exemption for this kind of a transaction. However, the FAQ released talks about capital gains on sale of shares of UAE company may not be taxable. So that is the contradiction currently, but like we all know, the law should prevail over the FAQ unless some notification or amendment to the law is brought about. Then in UAE, they have also provided a concept of tax groups. So tax groups are typically group companies which can come together and form a tax group. There are certain benefits of tax group, mainly from a compliance standpoint, whereby only one compliance has to be done by the parent company. Second benefit could be set off of losses between the group, which would happen. Only restriction here is that if you have any entity which is an exempt person or a free zone company, you cannot form a tax group. Again, all group members must use the same financial year and same accounting standards to ensure that no undue advantage is taken. Minimum 95% common ownership is required in order to form a tax group. They say that parent company would be responsible for all the obligation, but the liability would remain jointly and severally. So if the government is not able to recover the liability from the parent company, they can even go to the parent company. Subsidiaries can be added, deleted. Parent company can be changed by making applications to FTA. So this group structure could be very useful for large corporates where they anyway just have to pay tax. Then it would make sense to combine it if there are loss-making companies in the group. Only thing is that the moment you do this group, you may lose out on the advantage of 375,000 AD exemption, which is available currently to each of the entities. It will get consolidated and the exemption would be available only one time rather than each entity claiming it. So pros and cons of forming a tax group would have to be evaluated very, very minutely before actually forming a tax group. Then there are certain group relief provided and restructuring relief provided. They say that if you do any intra-group transactions of transfer of assets, shares, etc., then if you satisfy two conditions, that is you have a common ownership of more than 75%, more than or equal to 75%, and the asset or liability which is transferred remains within the group for more than or equal to 2 years, then there would be no tax on the initial transfer. Second, transfer can be recorded at net book value, and hence there would be no profit and loss on the transaction. Obviously, transfer pricing would be applicable. Transfer pricing would say that the transaction would have to happen at market value. But I think so this is a specific relief provision. So most likely than not, they have a common wordings in the law that if there are contradictory provisions, then whatever is logical has to be interpreted. And basis that we can interpret that transfer pricing would not apply here because a specific relief has been provided, and hence the transaction can be carried out at book value. If we breach any conditions in terms of 75% ownership is diluted or the asset is transferred outside the group before the 2 years, then the market value would be taxable in the hands of the transferor in the year in which this condition is breached. In addition to this, they have also provided certain relief for restructuring. So this is relief for mergers, demergers, amalgamation. Again, same condition. If you are doing mergers, all of this for shares through swap of shares, here the relief is for non-cash transactions. So here you can do mergers, demergers, but all it should be non-cash transactions, and the relief would be allowed subject to the business not being transferred within 2 years of the initial transfer being done. Now they've also provided provision for general anti-abuse rules. So it is nothing but similar to our GAR provisions, and in fact even more more complicated than the GAR provision, because it talks about provisions for disregarding transactions not entered for valid commercial reason and purely for obtaining corporate tax advantage. And it defines what is a corporate tax advantage, refund or increase. So if either because of some structuring, it is leading to refund of corporate tax or increasing refund of corporate tax, that would be considered as an advantage. Or it results in avoidance or reduction of corporate tax payable, would be considered as an advantage. Or it results even in deferral of payment of tax or advancement of a refund, would also be considered as a advantage, and avoidance of obligation to deduct or account for corporate tax also would be considered as an advantage. Where GAR applies, tax authority will issue an assessment order determining the CT advantages obtained and to be counteracted or adjusted. Various considerations are listed which must be considered in determining the applicability of GAR. And one of the important point here is that they are saying that the law would be applicable from 15 days of its notification. And if you see the law, while it is released on 9th of December, the law has a date of October on the heading. So technically from 20th October or so, the law was applicable. So any structuring you do or are doing in the current period would have to meet the GAR test, and it cannot be said that corporate tax law was not applicable, so I could do whatever structuring I want to avoid tax or to get benefit of some provisions which are there under the law. So this becomes very critical for corporates to relook, and even if they are doing some genuine restructuring, then whether it meets the test of GAR or not becomes very, very important and relevant to be examined for those businesses. Now, coming to the second part of the regulation, which is the transfer pricing regulations, which have come in under the UAE regime. So if we look at the landscape of the entire GCC region, now majority of the countries in the GCC region has implemented transfer pricing by and large. So any group company transactions by and large will have to meet the transfer pricing test, and you cannot now have situations where you are looking at jurisdictions only from one country perspective. say for example, if a UAE company has a subsidiary in India and they think that, okay, in India transfer pricing is there, in UAE transfer pricing was not there. So I can give even a higher markup to the Indian company for whatever services it is providing, and I buy peace with the Indian tax authorities. But now you will have to relook at that arrangement, because now UAE will also question that for the kind of activities your Indian subsidiary is doing, it does not merit a markup of 20%. It should be 12%. It should be 15%. So now transfer pricing has to be done looking at both the jurisdiction, and in fact, more and more jurisdictions are introducing transfer pricing. So it becomes very, very relevant to look at both the jurisdiction and not being always saying that conservatively India is stricter, so you give a higher kind of share in India and forget the other country. So Kingdom of Saudi Arabia has signed the BEPS framework. It has introduced local file, master file, CBCR, and also a disclosure like 3CEB in its own return. Qatar, again, yes. Oman, yes. UAE, yes. All of Bahrain, yes. Only Kuwait is somewhere still transfer pricing laws are not introduced. You also see Qatar, UAE, and Bahrain also has ESR regulations. So more and more globally, the regulations are getting stricter. Intercompany transactions are getting scrutinized more and more. So it becomes very, very relevant when you are looking at a global structure for your clients to look at from both the angles and not only from India angles, because it becomes very, very critical to be compliant on both sides rather than only looking at India while advising. So again, on transfer pricing, arm's length principle. So mainly the entire transfer pricing concept is based on the OECD model. So they talk about transactions and arrangements between related parties and connected persons to comply with OECD transfer pricing guidelines. Arm's length price to be determined using internationally recognized transfer pricing methods. Comparable transactions with unrelated parties can be used to benchmark. Disclosure requirements are there in line with BEPS 13. Both domestic and international transfer pricing is covered currently. Surprisingly, there is no threshold. So today, even a single AED transaction would be covered under the transfer pricing regulations per se. They have prescribed the 5 methods similar to India: the CUP, TNMM, resale price, profit split. And they say that if you feel that all the 5 methods or combination of those methods are not relevant, then you can apply any other method which has to be justified if applied. Again, arm's length range concept has been introduced. It would not be a one particular price, but a range which you have to fit into the range. Again, however, what would be the range is not specified, and that would come out shortly as to what would be considered as a range. Then disclosure filing along with return of income would be required, and reporting all the transactions with the related parties and the connected person. Enabling provisions provided for making corresponding adjustment. APA provisions provided. Also, they have provided for making application to FTA for making corresponding adjustment. So for a UAE company, if some adjustment has been made in India to their Indian subsidiary, they can actually make an application to FTA for making a corresponding adjustment in the UAE books. Other than the related party, which is a usual concept everywhere in all the countries, they've also introduced a concept of connected person. Connected person is more like an owner, director, or key employee, or a related party to the owner. And if you are giving any benefit to that connected person, see, this is very critical there, because the individual, there is no tax. So in order to reduce my profit, I can give perquisite to my owner, I can give higher salaries than market and reduce my profits. So that's why they've introduced this. Or I can make expenditure for him which is not relevant for business. So now all of that also would have to be benchmarked. So similar to when domestic transfer pricing had come into India and we had it applicable for smaller number, now it's applicable only to a few companies. There were questions on directors' remuneration, right? Or the promoters' remuneration, how it has to be benchmarked. So those challenges in terms of how it would be benchmarked. Because today we have different salary for Mukesh Ambani, and he's taking 1 rupee and somebody is taking 1 crore. So those kind of benchmarking would become difficult, and we'll have to devise, basis our experience, proper methodology to benchmark this kind of transactions. Then finally, on the tax administration part, they have said that companies would have to register and take a tax identification number. If the company is no longer doing business, then there is a process for deregistration as well. The governments would have right to deregister themselves if there is no direct information by the company. Automatic deregistration can be initiated by the company itself. They currently believe in self-assessment principle. So you have to assess your tax, pay it. There is no advance tax, no audit or anything in terms of tax audit or something like that, which is required. Procedure for assessment and appeals would be laid down. Audit requirement would be prescribed. So the government will prescribe that which all companies would be compulsorily required to get their books audited. So earlier, all free zone companies were required to get books audited as per the draft law. But now they have changed it, and they have said that they will prescribe a list as to who all are required to get audited. Then if there are certain transactions where you feel that there is no clarity on the tax implication, then they have kept open a provision whereby you can approach the federal tax authorities to examine the transaction and give their views on the taxability of the transaction. Once the ruling or the implications are provided by the FTA, it would be binding on the FTA unless the facts of the transactions have changed substantially or have changed. Like I mentioned, return filing 9 months from the end of the tax period, return and tax payment. Penalties and fines also would be prescribed. The books of accounts and records have to be kept even by the free zone companies and mainland companies for 7 years, and the books can be called for by the FTA for audit as and when they feel so, depending on their selection process. Lastly, as corporates, what we should advise our clients, or if we have any Indian companies who are having subsidiary there, first is to look at what is the impact of this entire corporate tax, relook at their holding and capital structure with the interest deduction coming in, look at the substance in the UAE subsidiary if they have, review the entire transfer pricing policy and intra-group transactions, whether it is meeting both the criteria from India perspective as well as from UAE perspective. Look at financial transactions, intra-group intangible transactions, what possibly could be the impact. Look at complying with the law, preparing documentation, preparing accounting system, which will give you bifurcation of expenditure for the exempt income, not exempt income, qualifying income, not so qualifying income, all of that. So it becomes very critical for companies to do this and examine this before the law kicks in. Now, let's look at how a typical couple of case studies are there, and then probably we can go to the questions if there are any. And so typically you will have your sales turnover, and there would be a list of expenditure which would be there as a deduction, and then there would be your accounting profit. On that, you will have to give impact to various expenditure like the interest capital expenditure. It will have to be restricted to 30%. Business promotions would have to be disallowed, and ultimately you will derive a taxable income, take benefit of the 375,000 AED, and then work out your tax liability. Second, like what we discussed, that why a UAE company or a free zone company would select not to pay, not to go under the 0% tax rate, but actually go under the normal regime. So say for a UAE company which has qualified income as well as non-qualified income, but the portion of the qualified income is only 50,000 AED hypothetically, and not qualified income is 500,000. Then in addition to the problem of managing substance and transfer pricing, I may actually evaluate of moving out, because if I go under option 1, that is claiming the exemption, then on the entire, I will get an exemption on the 50,000. And on the entire 500,000, I will pay a 9% tax of 45,000. Under option 2, if I opt for normal corporate tax regime, then entire 550 would be taxed instead of 5, but I will be able to claim the deduction of 375,000 AED, and my net tax liability would come to only 15,750. Then on the capital gains, which we broadly discuss, and dividends. So if you look at example 1, where ABC company has 30% holding in a foreign company and 3% holding in the UAE company, dividend received from the UAE company would be exempt because there is no participation exemption test for a local company. Participation exemption test is only for a foreign subsidiary. So there I will have to check whether PQR is paying 9% tax in home country, whether my intention is to hold this investment for more than 1 year. Then I will claim, then I will get an exemption of that 30%, of the dividend income. And similarly for capital gains, like I mentioned, if I am in a location where the tax rate is lower than 9%, then there would be no exemption which would be available. So with this, I'll like to end my presentation, and probably we can look at a few questions which are there from the audience, if any.
Thank you, Nishit ji, for taking us through with the Dubai tax provisions. Quickly, I'll take up some queries before we conclude. The first query is by our coordinator. So if I may request the coordinator himself to ask the query. Aditya ji, over to you.
First question was from Toral Shah. A beautician resident in India goes to UAE for giving makeup service for a wedding in UAE. Will fees received be taxable in UAE?
So like I mentioned, for natural person, they are going to come out with a specified category of activities which would be considered as taxable. So from an Indian resident perspective, first we will have to look at what kind of visa that person is going. Whether he or she is going basis a work visa, tourist visa. If it is going on a work visa and that particular type of visa is what is covered, then definitely they may be liable to tax if it is covered under the specified visa. If somebody is going on a tourist visa, then ideally nobody will come to know about it because it's a tourist visa. But if assuming they are going through a work visa or a professional service visa, and that visa related activity is covered under the specified business activity which is going to be prescribed for a natural person, then definitely this income is UAE sourced income because the activities are rendered in UAE source. And if that individual is covered under the specified business, in my view, they would be liable to pay tax in UAE.
Mostly, I think they would not go for a work visa for this event, I think.
Right. So nobody will come to know.
Yeah.
That's then not liable to tax. No, nobody will know. That's the answer there.
Somebody like me who travels on US visa,
Right.
14-day I can work and come back.
Okay. Yeah, that's another angle. Yeah.
If Toral, you are online, if you want to ask something else, or your query is resolved now? Shagufta ma'am had 2-3 queries, so I'll ask her, request to ask in person. Thank you.
Sir, I just wanted to understand if this would be applicable to branch or licensing office that we open in Dubai.
So what is applicable? Corporate tax.
Yes, because it's a branch of corporate Indian corporate office.
So a branch is included in the definition of permanent establishment. So income attributable to that branch would be liable to tax in UAE. And obviously, depending on how you are treating it in India, you will be able to claim the credit of that taxes in India. From a license office perspective, license office is not allowed legally to do any commercial or business activity. And hence there is no question of income, and hence there should not be a question of tax.
Okay. Okay. So can we have your contact, please?
Sure.
Yes, madam, I'll share it on the
Yeah,
group
we
as
will
well.
share.
Okay. Thank you so much.
No problem. ma'am. I'll
From
share
the
the
old
email.
query, there was one top-up query that in case a modeling assignment in Dubai also on similar lines, so that would be taxable because mostly they will go on a work visa, I think.
So in a modeling assignment, there would be again work visa related angle and also most likely a UAE company paying for that modeling assignment. Uh, Again, for individual, we'll have to look at the specified services. If that kind of services is covered. So see the conceptually what has happened that individual is, they are saying that we don't want to tax them. Only for specified activity we'll have to tax them.
Correct.
So they will have to determine whether this is covered under specified activity or not. Or if they come with the list which is applicable only to natural person of UAE and not for other non-resident, then everything is taxable in UAE for us as individuals, unless they come with a common definition.
So we have one request for your PPT that we will share to the conveners, so we can share it to the other persons. And one last query was from FB Patel. Person holding residence visa of UAE but is a resident of India. In such case, whether liable for CT and what is the exemption, whether he is be taxed again in India?
No, so again, same question. You're holding residency, but what is your activity in UAE? If you're just holding a golden visa just to visit there, and you're not going to do any activity there, there is no taxation there. For individual, there is no taxation, even if you are earning dividend income, capital gain income, or other investment related income or salary income also. Only if you are falling under specified activity, and most likely what was there under the draft law, like I mentioned, that if you are holding any commercial license which is required as per the law of UAE, then those activities would be liable to tax for individuals. So if you are just holding a visa, not doing any business or commercial activity in UAE, then you need not be worried about.
One question I had was whether the free trade companies can elect different options on a yearly basis in terms of whether they want to go for that threshold or no.
So it's a one-time option like we have for a 25% rate. You can't go back.
115 BAA.
Yes.
Sure. I just wanted to know.
A resident of UAE, then his global income will be taxable similar on
Yes.
Indian income would be then taxed there and we get a credit of same rules.
Yeah, but for individual it is not taxable. So
Okay.
for a UAE company, global income is taxable.
Nikhil Porwal ji had a question.
Go ahead and ask, sir.
Yeah, hi, Nishit. This is Nikhil Porwal. We recently had one query wherein there was a company that was formed in the FTZ free trade zone, and there was some remittance to be made from India as professional fees to that company. So under the 15 CACV thing, do we need to deduct TDS, and how do we obtain a TRC from a free trade zone company?
So this is a more India specific query, but let me answer it.
Yeah.
So see, one is that tax residency certificate is available. We have clients who are giving us tax residency certificate, and depending on the type of service, you need to examine whether it fits under the Indian local laws 916, 917.
Yeah.
And India UAE tax treaty does not have a fees for technical services clause.
Oh, yes.
So if it is a professional fees paid to a company in UAE, most likely under the tax treaty, it would not be liable to tax, assuming you have all the documents which are required to claim a tax treaty benefit.
Okay. Otherwise, it will be straight 20% since they don't have a PAN out here.
Not necessarily. It could be 10.92%. There is an provision under 206 AA or AB subsection 7, which provides for certain exemption. And there are so many decisions of Serum, Infosys, which says that you can still opt for the lower rate, and basis with this exemption it comes. So there may be a possibility to claim 10.92 as well on this payment, even without having a PAN.
Acha. So, can I just write it down as to exactly what you said? Because I was not able to locate this 10.92%.
Yeah, so this section which provides for 20% tax rate,
Yeah, 206.
yeah, that also has a subsection 7, which takes you to the rules, and rules provide for the documents. So if you can
So if they
collect,
give the documents, then they can go
yeah,
for a lower rate.
yeah.
Okay.
But yeah,
Okay, thank you very much.
There was a top-up question by FB Patel sir again. In continuation of our query and my client holding commercial license under 100% ownership as LLC in Dubai and earning about 5 lakh dirham or something.
sorry, the company is in free zone or not in a free zone?
Just ask him to unmute and ask. That would be better.
So let me answer for both. If it's in a free zone, earning qualifying income 0 and maintaining substance and complying with transfer pricing 0% tax rate. If it's in mainland, 125,000 dirham would be taxable. They will be able to claim deduction of 375,000. Obviously, we are assuming this 500,000 dirham is the profits and not the revenue. If it's a revenue, you have to look at the income. And if income is below 375,000, then there is no tax.
He is in mainland, he has mentioned.
Yeah. So then you will have to, so assuming this is net profit of the company.
Correct.
Okay, so if there are no further queries, then can we conclude?
Yeah, we can
Yes,
hand over again to Jitendra sir.
Now I request our deputy convener to give heartily vote of thanks to Nishit Parikh ji on behalf
First of all,
of Andheri Oshiwara Circuit, Andheri Study Circuit.
thank you so much, Jitendra ji. First of all, hearty thanks to Nishit ji for accepting our invite in a very short notice. A lot of us would not be aware, but there was a change in speaker for this today's session, and he accepted our invite within a day. And I'm grateful that you came to our study circle. Sir, thank you for giving us a brief overview of the Dubai corporate tax law, trying to explain us different nuances in the law in terms of the connected persons, tax groups, the reliefs, the restructuring benefits, also explaining us the exempt income, allowances, disallowances, basically taking us through that entire law in such a short time. And also giving us avenues. The last slide was really helpful in terms of giving us avenues wherein we can develop our practice. So once again, I thank you on behalf of Andheri Oshiwara Study Circle.
Thank you so much.
Thank you,
Happy to
Nishit
speak.
ji. Can you share the PPT with Utkarsh?
Yeah, sure. We'll do that.
Fine. Thank you. Should
Thank
we
you.